analyst. Darius, I want to begin with you. What should we expect from the Fed in tomorrow's statement? That's been the one area, the one group of people who every time they speak, we know the market is moving.
They're going to talk out of both sides of their mouth, Liz. And what you're going to see is that they're going to talk down sectors of the economy like housing and continue to talk up labor, which has obviously been quite strong as it is a late cycle economic indicator. So they're going to continue to talk about tapering and setting the pace for that, while at the same time extending the outlook for interest rate hikes to maybe even beyond 2015.
You are not a bull when it comes to the economy. You're a little concerned. Do you think, though, that at this point, it's time to tighten rates if the economy is still on unsure footing?
Well, so we've been throwing cold water, like our buddy Charlie Gasparino outside. We've been dumping cold water on GDP growth estimates all year. So we're now down at 1.3% for calendar 2014. We don't think the current Federal Reserve, particularly one led by Janet Yellen, has enough political spine to raise interest rates in an environment like that as we progress through the back half of the year.
But John Corpina, I mean, we got a great consumer confidence number today, and here we have stocks that aren't faltering too dramatically. So we may be worried about the economy, but hey, we're an investment show here, and we're talking about where you can make money. Is it still stocks?
I believe it is. We've got a pretty mixed bag of what's going on this week between economic data, earnings season, pretty significant headlines, Fed, geopolitical stuff. There's a lot that's going on into this market. So on a normal week, I would think that everyone's looking at the Fed. But really, there's other things that everyone's starting to really focus on. The issue, the crisis in Ukraine, the crisis in Gaza, very, very poignant headlines can really escalate to certain levels where U.S. involvement would start to bring some fear into investors. But clearly, what we're going to get out of the Fed is also something that we have to really gauge some points on. When are we going to raise interest rates? When is tapering going to fully get through our system and we're going to feel the full effect of it? Hopefully we'll get some information tomorrow. But clearly, as your previous guest said, they are going to speak out of both sides of their mouth. They're going to give us a little bit of information, but make sure they hold back a little. Don't want to spook anything too much. Last time when we had tapering, that they turned the knob up a little bit, the market kind of didn't know how to adjust to that just so yet in their plans. So tomorrow should be pretty interesting. And then, as you said on the lead-in, American Express, Twitter, some pretty big earnings that are going to be coming out that are really going to help investors and add to that confidence.
Trent, at some point, this market's got to grow up. Investors have to grow up and understand that we can't see rates at 0 to 1/4% for much longer. At some point, when we're getting good economic data, sprinkled in with some weak stuff, among housing, okay, fine, I get that. But looking at the 10-year yield, 2.46%. Yesterday, we had Dan Veru on saying, you know what, we're in a bear market for bonds. There's no point in being in bonds right now. Treasuries aren't really signaling much today, and the VIX is barely at 13.
Yeah, I personally think the path of least resistance for rates is further to the downside for a lot of the reasons we just touched on. But as far as tomorrow's Fed statement is concerned, I'd be extremely surprised if the narrative changes from the last few months at all, simply because there's really no incentive for them to change what they've communicated. We have the sanctions on Russia we touched on earlier. Geopolitical tensions in general are high. Housing data is still low. We still don't have the wage increases that the Fed wants to see. And until some of that stuff changes, I don't see them raising rates. And I would agree with the gentleman that was up first in this segment. They could, in fact, push them back when all is said and done. So I don't know that the yield in the 30-year is one that is attractive to a lot of people. But from a relative value standpoint, it's still there. And I think there's still going to be some demand for it in the near term.
Darius, knowing what we know and seeing that a headline out of the European Union saying, you know what, we're tightening these sanctions up finally. I mean, can't be the only ones here that think this is a bad situation. But what do you think? Is there a better way, a better place for investors to put their money?
Well, I disagree with the gentleman who said we're in a bear market for bonds.
That's Dan Veru, who was on yesterday.
Well, long-term treasuries are actually one of the best performing asset classes we've seen in year-to-date, up about 12 or 13%, far outpacing the market's performance, and particularly the early cycle segments of the market, like consumer discretionary, small cap stocks, and housing in particular. So we definitely agree with the gentleman that just spoke that the path of least resistance to rates is to the downside, particularly if you look at two things. Number one, consensus estimates for rates and the U.S. Treasury market in terms of this net speculative positioning is still very, very much bearish on bonds and then obviously bullish on rates. And secondly, you got to know your Fed. So since 2010, the maximum mid-year tracking error on their GDP growth forecast has been an absolute value of 113 basis points. These people have been literally wrong on growth for about a half for each of the last 4 years. So we think their expectations for 3% GDP growth through now to 20, who knows when, is going to be very, very wrong.
Well, I'll tell you who's been very, very right on things like crude oil predictions, and that's Jeff Grossman. But, Jeff, I don't want to talk about that today. We're seeing crude oil pull back, but the rest of the energy complex is high. I want to do something different. I want you to chime in on what you think the Fed may say tomorrow. Do you expect any surprises? Because you folks at the NYMEX are very much engaged in listening to what they say as well.
Of course we are.
Yeah.
But, again, I always find what comes out of there is directly affecting the equity markets. And our, let's say, response to the equity markets, sometimes is in lockstep and sometimes there's a disconnect. I would, tend to think that, like, again, the previous people spoke about, that probably they're going, they'll be talking about the tapering and all that. And that I still think the stock market is under tremendous pressure. I think it's up here with smoke and mirrors myself. I'm quite bearish on stocks in general. But, again, that, again, is going to weigh on our market. But I'm more concerned, as I always say, I worry about my market. And we have inventory figures tonight and tomorrow. And at least I'll have at least a better way, at least to guess, as we always say, about where we're going to go tomorrow. I think the news out of, let's say, Europe and the like is probably going to put a sort of a damper on any sort of downside action that I was hoping for. I'm expecting probably maybe a little sideways action for the next week or so in crude oil.
Yeah, and by the way, for those of you who didn't know, the European Union is imposing sanctions, in essence, against Russian banks, saying that they can't get financing from Europe. They're not allowed to sell shares, stock or bonds. So that's going to start to hurt them, I think. And, they're going to be having curbs access to technology. Exports are going to be restricted. All that and more. We're watching it. And, again, we're waiting on the president. He is possibly going to make a statement. We're there. Peter Barnes is at the White House. We'll get it the second it happens, so please stay with us on that. Our gentleman on our floor show, thank you so much. Darius, just a quick mention here. If you could tell me which asset classes you feel people should be adding right now and which ones to subtract.
Nothing has changed. So you want to be in long-term treasuries. You want to be in things that are the outcrop of slowing growth, which are utilities, REITs, et cetera. And you want to be basically underweight or short, an absolute perspective, the early cycle sectors like consumer. We really dislike department stores and restaurants, and we also dislike regional banks as the yield spread compresses.
You guys are bearish. Well, this is interesting. Now we know where to go when we need a bear on.
Well, one quick thing is what is the market? When you're bearish doesn't mean you're necessarily bearish on the stock market.
Sure.
We're bearish on certain segments of the stock market, and we expect certain style factors to continue to diverge.
Darius, it's great to see you. Thank you very much. We appreciate it. And we'll put all of your sector plays and all of your areas up on Facebook.com/Liz Claman. Thanks. Good to see you.
Thank you. Likewise.
Darius Dale is Hedgeye Senior Macro